All right, so that's good. Everyone is here. Good. So let's start it, guys. I've shared my analysis here that I've mentioned on my Telegram, right? So if you haven't had time to read it through it, basically, if you don't know what's happening, we did have an FOMC minutes this morning for me. Was 6 a.m. in the morning for myself. So if you can see here, let me just put my times on. Can't remember Sydney. So 6 a.m. in the morning here, FOMC meeting minutes. So basically, if we search, this is the public information, guys. If we search FOMC minutes on Google and type enter, we're going to have the first link is the Federal Reserve Board, basically the central bank from US. And if we click in there, we're gonna get access to the 2024 FOMC meeting reviews. Okay, so we're gonna have the statements, and we're gonna have the press conference, and we're gonna have the minutes. So this is the one that was released today, and indeed we can see that the dollar did react on a bad way. All right, so this is the dollar index. And we just had here a big drop to the downside. If we look to the euro dollar, we did shoot up, and I was talking about this shoot up on my analysis here. So if you had time to read my analysis, I was aiming the 61% of the fib level, and that's exactly where it got hit. All right. So if we click on the analysis here, I'm going to start posting more those quick analysis of like sort of day trading. They're pretty handy, I would say. Okay, that's exactly where I was looking for. At the 109 level. Okay, that's my target, but it got on the 61. Euro dollar aiming for 61% of fib level, just as it was. Okay, just as was predicted. I'm going to run through this analysis soon. But why? Why did the euro dollar didn't went down as we were predicting, and why did it went up? Well, the reasons are simple, because on what we're going to see today, the PDF here from the FOMC minutes, first of all, let me send this link for you guys. So if you want to go through with me, you can check it up. It was pretty dovish. Okay, what does dovish means? Dovish means when the market is when the central bank is more cautious on raising rates, or maybe putting rates down on a quicker way. Today was pretty interesting day, to be honest. I even did a podcast with Peter Pan that we're gonna be releasing tomorrow, and you guys will be able to watch it. So today was a pretty busy day. Actually, we had to record it. It was probably 25 minutes only, not a big podcast, but full of content. And this is where most of the time on the podcast we talk about the FOMC minutes, and we've talked about as well the news we're going to have tonight, the PMIs. Okay, so if we look, we did have German manufacturing PMI much weaker than expected, but the services PMI came much stronger. Well, not much stronger. It came stronger than expected, right? 0.2. But all of the French PMIs, it came much stronger than expected. Well, there you go, Matthew. Congratulations. And the most important one, the Eurozone, basically the Europe, they had a stronger PMI, and coupled with a sort of undecided, mostly dovish approach on the FOMC minutes to a stronger PMI, we did have a shoot up on the euro. Okay, strengthening the euro and weakening the power on the dollar. So for those who don't know, the DXY has the majority of the composition because it's an index, right? As it is an index, we do have a basket. All right, what I mean by that is we have we have other currencies that formulate this index. And the major currency holding the US dollar index is the euro. So if you actually put it, the US dollar index, let me take all of the drawings and add the euro dollar as a new price scale, and put this on line as well. Okay, you can basically notice that most of the movements are the opposite. Okay, the opposite. Same goes to Aussie and Chinese dollar, Chinese yen and euro dollar. They're very, very similar, all right, in a sense. On here, euro dollar and the dollar, they're completely different because the dollar has a big take on the US dollar index, right? So if we actually see the euro dollar is on orange and the US dollar index is on blue. So let's take for comparison from this point, okay? So DXY goes down, euro dollar goes up, euro dollar goes down, oopsie, euro dollar goes down, DXY goes up, DXY go down, euro dollar goes up, euro dollar goes down, DXY goes up, and then it goes basically like this, okay? And can you trade these? Well, you certainly can. You can trade nowadays. You can trade anything you want, but will this make you profitable? In the long run, most probably not. Okay, in the short term, maybe. All right. It just depends how the risk management you will have towards it. Anyways, so if we look at the, let me just fix it and take this off. So if we look at the actual 4 hour, we did have a shoot up pretty much because the 1 hour it will be even better because of the Europe PMIs. All right, most of the PMIs on Europe was positive. All right, French was very good. Only German was a little bit bad. Okay, the manufacturing PMI was really bad. But the services PMI was really good, 0.2 above. And then on Europe, that's the big take, the big boy, the composed PMI, as well as the services PMI, only the manufacturing PMI came lower. But there was a big jump on here and on here as well. So that was 50 from 48.8 from 48.4. So 0.4 above, and then after that, 2 points above, 2.2 above what was expected. Okay, so I told you guys that was having a very big effect on the market. I told you in the beginning of the week. I think it was Tuesday, if I'm not wrong, and because Monday we didn't have a video from the week ahead. So yeah, it was Tuesday, and then in 36 minutes we're gonna have the CPI. Okay, well, my take here is that we may have a lower than expected CPI. Okay, so if we look at the inflation on Europe, we can get this one here, Euro area inflation, this one. Okay, look at what's happening. That's pretty good. See, the Euro area in 1 year. So from January last year, 2023, to January 2024, because we don't have February yet, we did had a big decline. Where's my pen? Okay, from January 2023, we were at 8.5%. 8.5% of inflation. Can you imagine that in Europe? It's a lot, right? After, in February, we went down to 6.9%. That was a big drop. Nearly 1.9%. And then we went a little bit up, 7%, and then 6.1, 5.5, 5.3, 5.2, and then a big drop, 4.3, and then a massive drop, 2.9, 2.4, 2.9, 2.8, I do believe that we may have a tick to the downside here. Okay, maybe. Let's see what the market is expecting. Well, the core CPI year is expected to come at 3.3%, okay, from January to January. The month over month is expected to come negative. To be honest, I don't think we're gonna have something that huge. I don't think it's gonna be negative, because we did had services PMI above what was expected for February. So what does that mean? Services PMI, I think I haven't explained this to you guys. Let me share my other screen. Just a second. This one. Okay. Now, so we have manufacturing PMIs. Manufacturing. Okay, let me do like this and then like this. So PMI. Manufacturing PMIs and services PMIs. Does anyone know the difference between services PMI and manufacturing PMI? Just really quick. No? No? Okay. So the services PMI, let's start with the services PMI. Okay, first of all, PMI stands for Purchasing Managers Index. Okay, Purchasing Manager Index. That's let me write it down here. Purchasing Managers Index. Okay, that's what PMI stand for. PMI Purchasing Managers Index. Right, let's start on services PMI. Let me grab pink. Right, so the services PMI refer to the economic activity that it's something intangible. All right, you can't touch, and typically it involves transactions where no physical goods are actually transferred. Okay, instead the services involve the provision of a skill or an expertise or a time or a performance from someone to the society, to the economy. All right, what would be a example of that? A coffee shop. Okay, coffee shop, it is an example of services, services PMI. Coffee shop. Why does coffee shop have service? Well, because we have the waitress. Okay, because we have the waitress, and the waitress do provide an skill. There is, you know, carrying the jugs around and putting the cups on people, doing the coffee or anything else. So the waitress is providing a service to a customer, but as well as for the business, for the owner of the business shop, because, you know, most of the times those coffee shops, the biggest ones, they don't have, the owner doesn't even know how to turn it on the machine. So he needs someone that have the expertise, that have the time on the industry, that can do a good perform coffee, and they have the skills to serve the customers. Okay, so this basically is the services. Now, the manufacturing PMI, it sort of basically, you know, talks for itself. It's manufacturers a business involved in the production of something that is tangible. All right, most of the times tangible goods. Okay, so they transform raw materials into finished products with you know, which can be the sold to customers and business. An example of that is a kitchen maker. All right, so it can be, let me change the color. It can be a woodworker, a kitchen maker. Let's call it a kitchen maker. Okay, now the kitchen maker do have the people, the person that will work for him to do what? To take the measures. measures guy. All right. So we have the measure guy. Then we'll tell the measures for the kitchen maker, and the kitchen maker will manufacture the kitchen, and then we'll tell the measure guy that it's ready to install. And then the measure guy will get the kitchen and go to the customer's property and install the new kitchen for them. All right. So in one transaction, we have the goods and we have the services that someone is providing to the economy, to another person, all right, to a customer. Do you guys got it? I think it's pretty straightforward. Manufacturing PMIs are tangible goods. How much tangible goods were produced in one economy in a given time. And services is how much people are actually servicing other people, all right? Now, we have something called the 50 line on the PMIs, okay? I'm gonna show you in a second. Let me just take all of these and do a box, okay? And then I do a drawing here, 50. Okay, imagine, well, it's not perfect, but imagine that this line is the 50%, okay? Imagine that this line is the 50-50 here. What will happen is the PMI is a measure that fluctuates. All right, sometimes it can be good, sometimes it can be bad, sometimes it can be very good, and then bad, and then good, and then goes like this. Okay. I'm gonna show this on real life just in a second. Oh, but here it is. If we have a PMI, especially a manufacturing PMI, lower than the 50, it shows us that in the past scenarios, when the manufacturing PMI was below 50, we did have a recession. Why? Why is that? Does anyone maybe know why? No? Because when we have manufacturing being very low, it shows to us that people are not buying products. And if people are not buying, of course, there's no need to produce goods, because there's no one on the market that will buy it. There's no need for you to produce the whole brand new cars if there's no people to buy because they don't have money. So that means, whoops, people are not spending. There may be coming a recession, okay, for some reason. I'm going to show you this in a second in real life, but I just want you guys to know the concept first, okay? But to summarize, services encompass a broader category of intangible economic activities, and the PMI is a specific economic indicator that does relate to the manufacturing sector. And the manufacturers are business engaged in the production of tangible goods, right? So this is pretty much it about PMIs. Now, let me show you a real life PMI. Where's my screen? Share this one. See, we just had the services PMI and the manufacturing PMI. Services manufacturing PMI is 47.1. This is not good at all for UK. But services PMI is on 53.3. So that's positive. Let's see what just happened with the pound. The pound went down, okay, just now. Why? Because the services PMI, the manufacturing PMI is lower than expected, okay? Now, let me show you something. Let me go for Europe manufacturing PMI, okay? This is what I want. Let me put in 10 years, 5 years, 10 years. Okay. Where's my pen? There we go. Right. So 2014 here. Okay. We were somewhere between 50 to 55. So let's call it 52.5 here. No, a little bit more, 53. So 53 here. we went down, we touched the 50 line. Remember, the 50 line is this one here. And then we went up, all right? We went up, we went up. Remember this top here, guys. Remember this top. I want you guys to remember this later. And then what happened? We went down. And then what happened here? It was below 50. Below 50. This was before 2020. And then what happened? Pandemic comes in and it actually have a recession. Okay, so the PMI was already predicting a recession because it was already below the 50 level that I've just mentioned for you guys. And then it went up. Why? Because, you know, we did have a very good recovery, business got up, government stimulus and so on, and we went up. What happened on this area again? All right, these tops and bottoms of the PMIs, they are sort of a price action. You can count with them. I'm going to show you pound, and you can see that it's going to be much more choppy. And you can see that the actual tops and bottoms, they are sort of respected, not all of the time, but it's like a high point that you need to have a look on that, what's going on. And then it went drop again, and then now it's below 50. Okay, so that's a problem. That's a real problem. That's not good for Europe. That's not good for Europe, right? So once we have this in mind, what can we start already thinking about Europe? Well, it's below 50. In a long term, the market will react as bearish for Europe. Okay, now let's have a look on USA manufacturing PMIs. We go 5 years. It's just above the 50. Okay, it's just above the 50. And look at what just happened here as well. We did have a bottom here and another bottom here, and it went up a little bit, and then the COVID started. Okay, we had a top here, here, and here. Okay, all of the times it went down. All right, if I put on 25 years, most probably it's going to have more tops that I can show you to you guys. Let me get a line and put a straight line. Okay, look at that, top, 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 right? So that's something for you guys to always keep a look on it. I do believe that it's a very strong indicator. So just bear in mind, it's a very, very good indicator to have on your trading tools. Okay, so how long time we have? We have 20 minutes yet. Where am I? Here. Okay, here. So we just had all of those PMIs, and we had a higher services PMI. Okay, higher services PMI and higher lower manufacturing PMI. So pretty balanced on there, but the manufacturing PMI, that is the most important one, is going down. Okay, and that showed me good probabilities for euro dollar continue to go down now. That was a good pullback, I would say. Okay, that was a good pullback, and it does show me that we can maybe continue to go down. Okay, maybe. So I still believe on euro dollar down. That was my day trading. I've sent my day trading here for you guys. Got my target hit. Most probably now we will continue to go down. Why is that? Because I've just mentioned, I'm believing that CPI will come lower than expected. And if we have lower CPIs, that it's of course very good for Europe, you know, in a sense of the population, they're having lower inflation. But if we have a lower CPI for investors, it's not good, because it just shows us that the central bank will cut the rates, and if they cut the rates, investors will get paid less. And if investors get paid less, what are they doing with the money there when they have other places to invest their money? Okay, so just think about that, right? Now for tomorrow we have initial jobless claims for US And then we're going to have services and manufacturing PMIs for US. So very strong, okay? I do believe it's going to come stronger than expected. And if it does come stronger than expected, then is another positive reason for me to keep shorting euro dollar, okay? Because euro dollar came in much weaker manufacturing PMI. Now USA will come maybe stronger PMIs. So it's just showing to us the resilience, okay? And this is exactly what I want to show it to you guys on ACY website, if I have it open. Just a second. So for those who don't know, I do post content every day, blogs every day. So you can go learn here and you go market analysis. And then you have my name here, Luca Santos. We have Nathan Bray, Duncan, Michael Maron, some other analysts. And this is the one I've just posted today. Okay. And here's some of my interpretation for the FOMC minutes. Okay. So when they address the financial market developments, it's exactly on this part here. Let me just show you here, developments in financial markets and open market operations. I've read it through all of this, okay? And what are they telling us is that the FOMC did discuss the financial market conditions, and they did note a modest easing, but emphasizing that conditions remain relatively tight compared to the start of the hiking cycle. Nominal treasury yields declined, especially at the shorter end of the yield curve, mainly due to lower expected policy rates. Equity prices reaching new highs, as we can see as well on indices like NASDAQ last year was crazy. NAS 100. Let me put in the daily. If you look at the NASDAQ, right, 2023 here, let me take this off. 2023 all the way to 2024, mate, this is 60% up. Can you believe making 60% on your capital, not doing anything? So let's say, you know, simple maths here. If you've bought $1,000 of NASDAQ at beginning of 2023, you would have $1,583.38. Okay, this is NASDAQ. All right. Nikkei, what happened with Nikkei? Yeah, look at Nikkei. I mean, let's have a look on here. It's 32%. Okay, so all of those indices around the globe, like S&P 500 as well. I know it's not an index, it's a stock, but look at how much it went up, right? From 2023 all the way, it's 25%. Okay, so 25% in a year. This is what really big hedge funds are doing, even though they are not doing too well quite past couple years. The all-weather portfolio from Ray Dalio have closed negative, I think, this year. Okay, sorry, 2023. So there are lots of opportunities happening, not only on the Forex market, but as well as widening your portfolio does repercute in a more opportunities that you can take advantage on, right? So I've talked about euro dollar. Let me finish on here. Where is, again, there we go. Now, equity prices reaching new highs, primarily driven by large cap technology companies. Yes, last year we did had so much technology coming into the market. AIs, the boom of AIs. No one was believing on Elon Musk, you know, and Nvidia and those big techs that were actually investing in AIs. Remember, guys, there's a very big difference in investing in AIs and actually producing AIs. Investing in AIs is actually you invest in a software that will generate AIs for you to do specific tasks. Now, invest in the hardware of an AI, it's a completely different take, because you're producing something to sell to someone. You're not taking advantage of the actual automated intelligence, artificial intelligence. Okay. Anyways, just food to thought. However, broader equity valuations more restraining, signaling cautions, optimism about economic resilience. Now, monetary policy expectations, right? That's the big one here. Market participants interpreted recent inflation data and the December summary of economic projections, we call this the SEP, as increasing the likelihood of earlier rate cuts. Okay, the model path of the federal funds rate, as indicated by service, showed a slightly increased probability of earlier rate cuts. Option prices also suggested a decline in the expected path. There was heightened market attention to potential slowdown in the balance sheet runoff, with expectations of a slowing pace starting by July. That's where the US dollar got weaker. Remember, I've explained it to you guys, I think it was Tuesday or maybe last Thursday, can't remember, but I've broken down these. Okay, when we have a central bank expected to cut rates on March, and now we are very close to March, and then it changes to July, it's hawkish, because we have more time to keep our money on that country. But when we expected to cut on September, and then now it jumps backwards to July, we have less time. So now it's maybe time to start to get a little bit of the money off from that part of the world, from that country, because the rates will go lower sooner. And this is interpreted as bearish, as dovish for the market, the participants. Okay, so this is the big take. Market participants interpreted recent inflation data and the December summary economic projection as increasing the likelihood of earlier rate cuts. The model path of the federal funds rate, as indicated by service, shows a slightly increase of the probability of earlier rate cuts. Right? So just pay attention on that in the next months. Let's have a look here on the CMA Fed Watch 2. Just a quick one. I know it changes every day, but I just want to show it to you guys. Now, March, okay? No one is expecting nothing. All right, only 4.5% of the market is actually expecting a cut. All right, so that's pretty much nothing. May, 70% of the market is expecting a pause again. Now, June, 53% of the market is expecting a cut. So it was on July, and now it's on June. Okay. Everyone was expecting to be on July, and now they're expecting to be on June. So just keep a look as well on those figures. Okay, let me send the link here. You guys can follow up with every day, whatever you want. But just keep an eye on the 5 to 525. It gets bigger, then yes, the US dollar may have in the end of the March, end of next month, end of first quarter, may start to go weaker. Okay, so just pay attention on that. Now, moving on, money market and desk operations, that's not too important for what are we talking right now. Economic situation. The economic review indicated a solid growth on US real GDP in the fourth quarter of 2023, and I did call it. If you work with me, you know I did call it a stronger quarter for GDP. Thought it had slowed from the previous quarter. Labor market conditions showed signs of easing with a slower pace of employment gains. Consumer price inflation had declined but remained above 2%. Now, the CPI here that they mentioned is above 2%, still 3.8% or 3.2 if I'm not wrong. if I don't miss the numbers here, somewhere around 3 to 3.8. But they need to bring this inflation down to 2%. Okay, so just bear in mind, we need inflation down to 2%. Otherwise, the bank will continue to hold the rate. And I don't see a reason why they would cut right now. Okay, this is my take. Labor market and inflation. Labor market conditions were tight, but signs of easing were evident, with its lower job gains and changes in unemployment rates for different demographic groups. Consumer price inflation continued to slow, with both total and core CPI inflation below the year-early levels. Survey measures of short-term inflation expectations decreased, while medium to longer-term expectations remained broadly in line with pre-pandemic levels. Considering recent strong US economic data releases, the US market has adjusted expectations, pushing back the anticipated timing of the first Fed rate cuts to June, exactly what I've just mentioned. While today's minutes might not discreetly alter those expectations, the possibility of an earlier rate cut in May cannot be entirely ruled out. That's what I think, okay? But looking at the tool that we know that it's pretty accurate, but it's the only problem, it does change every day because, you know, the servers are out every day. So just keep an eye on that. Right now, we're expecting on June, okay? But let's see how it may be. It maybe comes to May. If it comes to May, US dollar will be very weak, very, very weak, okay? Because then it's going to be even closer to March, and that's not good, okay? Do you guys have any questions regarding what I've just mentioned? No? Okay, good. That's good. Feels like I'm explaining pretty well, so that's good. If you guys have questions, you know, I don't have a problem on answering questions. Now, all of those 11 pages, if you want to read through, definitely. All right, definitely. It is very good. It is very cool. But I've just done it for you. The most important parts are these ones: financial market developments, monetary policy expectations, money market and desk operations, economic situations, and labor market and inflation, and a little rundown on everything. Okay, now let's have a look on the market. What's pumping? Euro dollar, I've mentioned already. I do believe that this is a good area to short, in my personal opinion. Let me just have a look on something here. Okay, let me log in there. Cool. What about GBP USD? Yes, definitely. I will touch base on that in a minute. So just finishing euro dollar. I do believe euro dollar can do certain movements. All right, touch there and maybe a continuation down somewhere around those levels, maybe. Yeah, gold as well. So this is my take for euro dollar. Okay, if my Bloomberg opens, I would help, but it's not opening. GBP USD, I still holding my my short position in there. Okay, guys, still holding my short position on GBP USD. Let me just take all of this off.
Are you going to add another position? Because you said you'd be adding another position.
Yes, correct. I'm looking to add more positions on GBP USD. As we just had now. Where is it? Oh, that's tomorrow, today. We just had the manufacturing PMI coming lower than expected. So this is a good take for me. If CPI in 5 minutes comes even lower for Euro, that's going to be very bad for UK as well. And then we are expecting a stronger US manufacturing CPIs, manufacturing PMIs. And if it comes stronger, then it would be very good for the US dollar as well. But yes, At the moment, I don't see any area to enter a good position because it may come a little bit higher. All right, it may come somewhere around here and get me a drawdown again. But remember, I've closed 50% of my trade here. I just have 50% running right now. Pretty tricky situation on GBP/USD, but in my personal opinion, I do believe that we'll continue to go down. But at the moment, for another entry point, remember, I don't like to entry on losing trades. I don't like to add positions on losing trades. This is not a very smart thing to do. You're just wasting your equity. You know, you're not actually letting the trade do what it has to do. But if the trade isn't positive, that's completely fine. You can add more positions following the trend. But on here, yes, I do believe that we can have another push down to 123. That's my main target, okay? And most probably this will fulfill the move, okay? The PMIs and as well the PMI, US PMI and the pound PMI will fulfill the move down. So that's basically my take on the pound. Okay, hopefully I helped there. Now, gold. Gold is the thing I've mentioned on Tuesday. My target got hit. That was on this one. Okay, that was this target here. Now is the time of a little bit more downwards. I do believe on a little bit more down. Okay, I'm not seeing below these levels. Okay, I'm not looking to go below these levels. I think it's too much. But if we look at the 30 minutes, let's take the drawings off. Oopsie. If we look at the 30 minutes, we are having a consolidation. Okay, and remember, it's a box. Okay, it's a box here. So most probably I would short gold somewhere, something like this. Okay, my target somewhere here, my stops above these highs, at least 1.8. Okay, somewhere around that. That would be my trade on gold. But if you believe that gold can go up and it fits on your strategy, that's good as well. Aussie CAD. Yeah, you saw CAD. CAD did have a very bad push. Put in 1 hour. All right, 2 minutes for Europe CPI. Okay. Let's see how it will go. You're welcome. Let me close these. Okay. What I want to show. Oh, Aussie CAD. Okay. Right. So Aussie CAD. Remember, Canada has a big take on US. Okay. So whatever happens on US, Canada does feel it. And it's a positive correlation. What does that mean? Positive correlation means that if the US goes up, Canada goes up, Canadian dollar goes up. If US dollar goes down, Canadian dollar goes down as well. Okay, so just bear in mind, Aussie dollar, it's pretty strong at the moment. Why? Because we did have the last meeting, the last, I think was 2 weeks ago. Yeah, risk on. Thanks, Matthew. I'm just trying to remember. I think it was 2 weeks ago we had the RBA, and they say that they're not looking to cut rates. And if they do, it's going to be later on the year. And the market was expecting more towards now. Okay, so there is a possibility to continue to go down, except if the PMIs come higher than what as I'm expecting, then the Canadian dollar will be positive and will take on from the Aussie dollar. So that's my take on Aussie CAD. Let me just take a look on FinLogix pretty quick. Okay, let's have a look on here, what we had today. It came as expected, all as expected. So if it comes as expected, then what does that mean is that it's priced in. So the market don't react anything. Okay, so you can see nothing much. So we have to wait for the market until I think it's going to be midnight 30 today for the that's in my time zone for the US. Let's just have a look here, Kumalo, in something. I want to see what the big mass is doing. Financial. Okay, this one. So let's go Aussie CAD. See, 70.4 of the market is short. Anyways, so this is all from me today. Hopefully I can see you all next Tuesday. Have a good one, and I talk to you all on the next webinar. See you guys. Have a good, God bless you. Bye-bye.